Stocks, bonds, ETFs, straight out of downtown Chicago. This is Zacks Market Edge.
Welcome to the Zacks Market Edge, the podcast about investing in your life. I'm your host, Tracey Ryniec, and this week, as I promised, I'm joined by Zacks Chief Equity Strategist, John Blank, to talk about what's going on in the economy and how can you invest when the Fed starts cutting rates. So, John, welcome back to the podcast.
Thanks, Tracey. We get great crowds for these types of events, so hopefully people like this one too.
Yeah. Okay, so just to recap for those who might be new to the podcast, John and I have been discussing this topic about whether or not there's going to be a recession for about 8 or 9 years. As long as this show has been on the air, we've been discussing it. And we actually had to discuss an actual recession during the pandemic. So one did happen. It was quick, but we did have one. But now, when the Fed started cutting rates again in 2022, the recession watch was on. And here we are almost 2.5 years later, and we still haven't been in one yet. And now people are getting a little bit kind of crazed about whether or not we're going to actually have one. So that's why I always bring John on to talk about it. He has a PhD in economics, so he's going to set us straight on what to look for, how can you tell if we're in one or not, and then we're going to discuss whether or not we are actually in one, as we always do on this podcast. So take it away, John.
All right, Tracey. So how do we do this diagnosis every show to start with? How do we do this?
We look at employment.
Right. So I'm going to go to the employment situation summary. I pulled it up. It came out on Friday, August the 2nd. And I'm going to read you what I need to read you. The non-farm the unemployment rate rose to 4.3% in July, and the non-farm payroll employment edged up by 114,000. And that's for July. So then I also tell you to go down to the revisions, because remember, August the 2nd was 2 days into August. So when the government tries to produce a July number with basically 1 day of overlap, that was a very quick household payroll number. A lot of placeholders in that number. That number is going to be revised, and probably dramatically. So let's take a look at the revisions for May and June to add them up. So non-farm payroll employment for May was revised down by 2,000 from 218 to 216. The change for June was revised down from 27,000 from 206 to 179. So Tracey, we have here, put these numbers down on a piece of paper. 179 for June, 216 for May, and 113 for July.
Okay.
Okay, so I'm going to pull up my Excel spreadsheet. Make sure we do this exactly correct. And we're going to do this addition subtraction game. So what I told you, 216 and 113.
Yep.
And what's the other one?
179.
And 179. So we got to do this, divide by 3. This is the average monthly payroll number. It's at 169.3. It's basically 170. So over the last 3 months, which is a quarter of time, which will pair up with GDP and various other things, we are at 170,000 monthly additions to jobs, correct?
Yes.
Okay, so what does that tell us in terms of the history that we've always been playing for 8 years? What's the Rubicon that we concern ourselves with?
Well, it has to go negative.
Yeah, and even before that, we need to at least meet the labor force growth of the U.S. economy. So there's 160 million people in the U.S. economy, that is civilian labor force. 1% growth is roughly 1.6 million. Divide that by 12, and you roughly get 125 to 150,000 people, right? So that we need to at least do 150 to be very conservative. And then we start to wonder on our way from 150 to zero whether we're getting into something to be worried about. But if it's above 150, we should not be worrying about it, right?
Right.
So what's the answer?
We should not be worried.
We should not be worried about it. Now, folks,
I have learned this over the years,
This
John.
is called a supported conclusion. I didn't dream this up. I've done this for 8 years, and I'm using the numbers as they're properly used, as I've always told you to use. We are not in a recession right now on the non-farm payroll numbers on a revised basis.
Okay, but let me ask you something. So I'm just taking I'm going to be the devil's advocate here because this is something that I've heard on like Twitter and other places. A lot of people who are claiming we are in a recession want to just strip out the government jobs. They claim those aren't real. They don't really add to GDP. So we have to strip those out. And those have been actually somewhat decent the last couple of months.
Right. So let's go again to the same report, and I'm going to read it to you. Government employment was little changed in July, went up 17,000. So the 113,000 had roughly 15% government jobs. Employment growth in government has slowed in recent months following larger job gains in 2023 and the first quarter of 2024. So why would government jobs, which, Tracey, are by and large state and local jobs, not federal jobs, why would they have grown across 23 and the first quarter of 24 and then slowed down? Why would that happen?
I don't know.
The same thing that happened in the private sector. People were going back to schools and teaching.
Okay, yeah.
Tax payrolls
for sure.
were going up, right? And so basically, as people grew out of the recession the pandemic, the recession was 2 months of that, and then the pandemic itself and the expansion and the recovery of that expansion, and then actually to the expansion, they were adding jobs just like the private sector, right? State and local jobs are driven by taxes. I mean, whether you realize it or not out there, non-farm payroll numbers that we talk to are put together for economists to set up from W-2 forms what payroll taxes people will pay, right? So when you get government statistics, you got to remember the first use for government statistics is to run governments. So governments are very concerned about cyclicality because otherwise they got to fire people or issue debt, and they don't like to do that. In fact, they don't like to do that. They would rather keep budgets balanced because they can get reelected easier, and that's very, very understandable. Very good conservative way to run governments. By the way, state and local governments are in that bulk of that number, and whether you're Democratic or Republican, that also washes out because half the states are Democratic and half the states are Republican. And by the way, the lowest unemployment rates because of fracking booms are actually in red states, so there's much more likelihood the state and local payrolls have risen in places like Texas, Wyoming, Oklahoma. So again, just from the perspective of what has happened, to speaking to the government numbers, basically they ran on the same trajectory as the U.S. economy, basically coming out through a strong pull through growth through all the way the first quarter of 2024, and now they're going sideways. So what is correct to the number and language, if they're worried about cyclicality, and they are, is they are going basically in a holding pattern for the last 3 months on job additions, still adding jobs, but not many.
Yeah.
So that is not a recession.
That
is not a recession. What?
Right. So the government is hiring all these people isn't the reason why we're having these kinds of numbers,
No,
obviously.
because that is a talking point that is targeting this idea that there's a 6% fiscal deficit at the federal level, and that federal deficit spending is going into federal jobs. And they're conflating the idea of a federal job, which is not the job I'm talking about. State and local government jobs are the vast majority of government jobs. I mean, if you look at Santa Barbara County, for example, how could I get a federal job here? I'd have to be at an Army base.
Yeah.
Right?
Or maybe
and
a national park.
That I'm growing Vandenberg's payroll.
Yeah. Yeah. It's mostly, police, fire, teachers, librarians,
social workers.
Yeah. All those types of local jobs.
Functions. Right.
Yeah.
Yeah. And these things are very cyclical. I mean, people are hired to do services. They're basically service economy jobs that are in the government, and they run on a cycle. So the service economy is probably the right metric that should be aligned with the government job numbers that people are quoting. And the service economy is starting to play out now after 2 years of growth.
Yeah. Another thing we've looked at on this podcast when we're trying to figure out what's going on are the weekly jobless claims as well, which is a little more recent data. And it's literally the people who are filing for unemployment in every state. But as we've talked about many times, you've always said that those claims have to go over 300,000 in the week and stay there for a little while to kind of be signaling that there could be a recession. And we're not even close to 300,000. We're not even going in the direction of it, at least not yet.
Correct. I mean, again, let's do what we tell people to do, which is go to the actual numbers. So I'm looking at the Thursday, August 8th numbers. So these are 5 days old. And the previous week's level is 250. And this week's level is 233. So 233, 250. And the 4-week average is 240, right?
Yeah.
So are we above 300?
No.
No, we are not. And we're trending down, by the way, from 250 to 233 in the last one. Unrevised, so we got to be careful here. But in general, not in a position of concern, particularly in August. You got to remember we're talking about August numbers. That is now half of the August numbers. So the August number in payroll that will come out in 3 weeks is already likely going to be fairly benign. And August and September really, I mean, when people do hiring cycles, you got to remember when big bulky things are usually January, sometime maybe October, we'll see. But in general, very, very unlikely to see this number move around much, less the rest of this month.
Okay. Now, what do you think about the number of layoffs we're getting? That's the other side of the equation. Some people have been saying, oh, we're getting all these layoffs and we're getting some big announcements again, which we did get in 2022 and somewhat in 2023. But now we're getting another round of the big tech companies saying, like Intel, we're hearing layoffs there of 10 or 15,000 people and, various other somewhat large layoff announcements. Some of those will take some time to work into jobless claims if they do at all, because you don't necessarily file for unemployment just because you're laid off. Depends on if you get some kind of severance or if you find another job right away, then you don't file. But what do you make of another round of large layoff announcements?
Yeah, again, I can go to data, layoffs and discharges, total non-farm on the Federal Reserve Economic data from the St. Louis Fed. June numbers are the latest, and it's 1.5 million. It's a low for the year. We were at a high of 1.68 million in May, and now it went down to 1.5 million. So 1.5 from 1 point, that's 200,000. So when you're talking these Disney things and Intel and all these things, you have to net out a positive 200,000 just to arrive back where we were in May, because we came out of a low in June on layoffs. So it does look like there's a summer layoff series going on. And in light of the non-unemployment benefits you just stated, it's very unlikely they're moving the dial because people are getting hired back relatively easily. On a net basis. You got to remember, Intel people getting laid off, that's a beautiful thing for Silicon Valley. I mean, those are the jobs that, are hard to get or people it's hard to find. I mean, we got the small business optimism to rise this morning, and it's been rising for several months. And part of it's rising, Tracey, because it's easier to find workers now. Right. You're in a too hot labor market as a small business. You can't get qualified workers or people leave your company. So keeping people on board or getting qualified people hired in is now getting easier. So there is optimism on the small business environment because of the very thing you're talking about.
Yeah. And those smaller businesses can also get the talent they couldn't get before. So they couldn't compete with Intel and its stock options and the glamour. And now if Intel's not hiring, that same employee, maybe just out of college, has to look elsewhere and is going to look in different industries and these smaller companies. And now they will get a lot better workers, most likely.
Yeah.
So.
Yeah. I mean, again, why we do the show to start with what's called a summary statistic. The summary is summarizing the entirety of the U.S. economy's performance in real time, a contemporaneous indicator, is we just do the humble thing of trying to make sure we get a signal, not noise, and that we net out everything. Because news reports, particularly in front of an election cycle, are not going to net it out for you. They're going to tell one side of the story or the other for the purposes of their audience.
Yeah. And isn't it true we can
honestly,
have...
I'm working for NBC and I say, hey, something's netting out. They're like, okay.
Yeah.
That doesn't get anybody excited, right?
No. But isn't it true we can have a slowing economy that doesn't completely go into recession? Because we've talked about in the past how some different industries have been in a recession for over 2 years. Housing has been in one. There's a couple others that have been, manufacturing has been in one based on all the data we have from manufacturing. So, but those are smaller parts of the overall economy and maybe not big enough to totally push us in. And then we have this catalyst of the AI growth. We have these huge mega cap companies spending billions of dollars in CapEx to build out that business. That's all going out into the economy as well. So isn't it true we can have kind of both things going on at the same time, but it's not, there is no actual recession. But if you're in housing and you're a home builder, you have been in one. You've been feeling it.
Well, I mean, first of all, what I've noticed is that the service economy employment numbers and wage growth is really stable and it's planing out. So what you're talking about is the cyclical part, which is the construction numbers, which are doing pretty well, right? I mean, you've got first quarter GDP in at 2.8, right? And can you pull up the Atlanta Fed GDP right now?
No, I can't. I know it. I think it wasn't it?
Yeah, I'm trying to pull it up myself.
Yeah. I know it was over 2 so far in the second quarter, right?
Yeah, it was the last time I looked. Okay, here we got. I got it at 2.9% on August the 8th.
Okay.
2.9% from 2.5%. So let's just, again, we're doing the numbers. We're not talking about our opinions on anything other than numbers. And we have to have 2 quarters of negative GDP growth to have a recession. We have final revised 2.5 numbers for the first quarter. And the latest for the second quarter is 2.9.
Yeah.
So, Tracey, what is the economy doing? Heating up or slowing down?
It's growing pretty strong.
It's heating up and it's outperforming. And a 2.9% GDP, if it holds up for another basically 5 weeks, 6 weeks, means that the Fed actually will not cut rates in September.
Okay, that was my next question. I was going to ask you whether or not you think the Fed is actually going to cut with this data that we're getting.
Well, if I have to go to the Federal Reserve meeting in September with a 2.9% GDP growth rate for the second quarter in hand, unemployment falling to 4%, stocks at 5,400, I'm going to have a hard time selling anybody on anything but stay the course and don't cut rates.
Okay.
Again, folks, we're doing a data-dependent exercise, right? So if we're looking for a recession and 2.5 landed in the first quarter and it's final revised, so it's a signal, not noise. We have 2.9% as our best estimate for the second quarter. So we're actually speeding up in the midst of all this discussion of recession. We're doing the opposite.
Right.
So you can actually think, wow, why is the 10-year at 3.85 and not 4.5? Good question. And if you're looking to refinance your mortgage, I'm telling you to go out and do it right now, right? Because it's probably planing out. The 10-year is probably planing out as we speak.
Yeah. Do you think the Fed, though, may still do like a quarter point just to kind of appease Wall Street? And
Well, here's the thing, Tracy, and I've said this in many international podcasts or shows, TV shows. I do a lot in Australia and Singapore and London these days. The thing you have to understand here is why the U.S. is not cutting. Other countries are already cutting. England is already cutting. The European Central Bank has been cutting. All across Latin America, they're cutting. The Swiss Central Bank has been cutting because their economies are much weaker, and so they do need the stimulus. We don't. And so what happens here is that the spread between their cutting and our not cutting is what drives currency markets. And that's what blew up the yen, right? So the basic problem here is not the U.S. economy. It's the divergence of our monetary policy rates with the central bank rates that have been cut. So in light of the falling core PCE rate, which is what the Fed cares about in their economic thinking for inflation, and in light of the divergence that have grown between their policy rates and other ones that have been cut, so the sheer lack of their activity has created a wider divergence. They're going to cut for those reasons, right? They're going to cut the real rate down, and they're going to bring their divergence into alignment with other central banks. That's the real reason they're going to probably cut in September. And that's how I would pitch it. If I went to the meeting in September, I'd say, look, the U.S. economy is still too strong, but I'm getting price inflation under control. We had a 0% month-on-month PPI today. We'll get the CPI numbers tomorrow. Likely they're going to be coming down into a slight disinflating pattern. So I can say, look, I have disinflation in hand. Let's bring our real rates down, even though the economy is too strong for that, because it's going to create better alignment with the international system of policy rates, and it's going to be better for a real rate perspective from the U.S. economy. We just simply have enough pressure on now in real rate terms, right?
Yeah.
So I think they probably will cut in September, but I'm just pointing out they may not cut for the reason that the U.S. economy is weakening.
Right.
Right? I mean, it's this is just showing you what happens when you talk to me. That's why I'm on the show. Versus, all this madness that goes through these social media channels on the print of every single number. The problem with jumping on numbers is that is not likely to separate the noise from the signal, right?
Right.
And that's
for sure.
You're getting decision making on noise and not signal.
Yeah. Yeah, 2.9% isn't even the muddle through. Remember when we used to get, like 1.5 and we'd be like, yeah, like back in the day after the Great Recession.
Right.
So
now let's go to here's a piece that is published from CNBC on Monday, August 12th, right? And here's the headline of this title. 59% of Americans wrongly think the U.S. in a recession, report finds.
Yeah.
Now, what do you think about that in light of what I just said? Proper headline or improper headline?
Well, they are playing up the recession fears in it. Yeah, because we aren't in one. So why are you, I don't know. But we know that there's a huge industry that wants to predict a recession.
Yeah.
We know that.
Industry. I said it to you privately. I said it to you for years. Let's say it publicly. There's this thing, and I put it in quotes, there's a recession industry, people. There's a recession industry, and people are employed to tell you about recessions.
Yeah, they are.
You get excited, look on stories. That one, they put that wrongly thinking recession because people clicked on that story. Recession calling, and recession is fear. Social media runs on fear, clickbaiting you, getting your fears driven up. They're trying to get you to look at articles. And the articles that tie you to reality, or podcasts like I'm doing, tying you to facts and explaining them, are simply over the head a lot of people. They don't have time for them, or I'm telling you something you didn't want to hear.
Yeah. Yeah. But don't you think this whole cycle has been a bit of a conundrum? And obviously, we've talked about this in the past, too. We are coming out of a pandemic, which we haven't been in over 100 years. So coming out of that, the economy is going to act a lot differently than out of any other kind of so-called normal recession. And a lot of money was put into the economy during the pandemic as well as, in response to it. And now this Fed cycle is acting differently than we've seen, because we've talked in the past about how once the Fed starts raising, usually you get a recession within 12 to 24 months, but we're well past the 24 months now. I didn't look it up, but I'm not sure what is the longest that it's ever gone without actually entering into one. This has got to be up there, though.
Oh, God, yeah. Historically,
yeah, because we are, almost 2.5, not quite 2.5 years now past when they started raising.
Right.
So I think that's also throwing off a lot of people, because normally we had all the recession is coming people about a year and a half ago, and then they got quiet for a while. But now they're back again because we really should have had one by now under the normal cycles and how it works.
Let's talk about your use of word normal. So here's the difference here. When you shut the economy down, you do what's called a supply shut, right? Any market has supply and demand. So all the recessions other than the pandemic and the Spanish flu of the last century have been demand driven, too much demand or too little demand. This one was where you shut the supply down and then reopen the supply up. So it's supply driven. So the problem here is when you aggregate all the historical episodes of demand-driven recessions with two supply-driven ones, one of which was the Spanish flu, which predates the Federal Reserve System itself, which they managed cyclicality quite well and lowered it down, is you don't understand that this is a truly supply-driven recession with a Federal Reserve emergency response in place that is totally different than what you've seen in any other instance in history, because the Federal Reserve did not exist during the Spanish flu period, and because all the other ones were driven by demand cycles, too much demand. So when you say cutting rates, lowering rates, that is all correct for the history, whether you go back to 1970, 1980, 1950, to demand-driven cyclical monetary policy events that do not pertain to this event at all.
Right. That's
the other thing
right.
to think about here is recession. If we had one in 2020, and very unique because it was 2 months long. So it's a 2 month long recession because it was a supply shock recession, because it wasn't cyclical like I told you. But if there is an expansion, which is a different term, an expansion means you exceed the prior growth rate or the prior level of the economy, which we have done. We're only in an expansion for 4 years, and expansions can go on for 10 years. So the other thing that's missing here in the language of discussion is expansion and how long we've been in one. And we've been in an expansion from that low, from that moment of panic, for 4 years, and 2 of those years were pandemic years. So I think we're probably 2 years out in a true expansion, probably 2 years in expansion. So that gets you more bullish. You say, well, look, from an expansion perspective, how long we've been expanding, how much air do we have to release out of this balloon, how much has been gathered, it's not dramatic.
Right.
From an expansion perspective.
Yeah.
Right?
These are all good things to talk about, because the layperson like myself doesn't think of it this way.
No, and you're being inundated with social media streams with 3 types of people. One are economists trying to do their job, which you're probably ignoring. The other is people trying to get people elected, telling you the things they want you to hear that are slanted and silted. Or the third is people jumping on immediate facts. People jumping on the most immediate payroll number, the most immediate service PMI, the most immediate thing that happened at the Federal Reserve System. And that is not sitting back and saying, hey, should I even care?
Right. Okay, let's pivot a bit to actual stocks now, because I did want to talk about what people should be buying if the Fed does cut rates in September. And so they could be kind of prepared. But as we've already mentioned, some of this is already being priced into these stocks. already, because the market is anticipating some kind of cut soon. And then you might want to be in some of these certain types of industries and companies. So one of the more interesting ones, I think, is on the building side. And I've been following, and I'm going to share my screen now for those who are listening, or if you're watching on YouTube. I've been following Builders First Source. I own it in the value investor portfolio, and it is a retailer, but who only services the builders. So unlike Home Depot, which services you and I, the do-it-yourselfers plus some professional builders, this one is only the pros. And with housing slowing and building down pretty dramatically, 30 to 40%, their earnings have really slowed. So I want to bring up the price of consensus on this one. They've lowered guidance a couple of times now because it's not rebounding yet, because the rates are still high, home buyers are still on the sidelines, so the sales are still low. But you can see they've come down for 2024 and 2025 off the highs on this price of consensus chart. The stock is cheap, but you can see also the stock has come back down off of the recent highs in 2024, because this reality is kind of setting in now. Hey, we won't really get a rebound in this until maybe the mortgage rates come down a bit more. And then we'll see. And, there's still the demand there. And the millennials are still out there buying new homes or remodeling, because this is also could be home remodeling. So what do you think about an area like Builders First Source? Home Depot just reported its earnings as well, and they said what we all knew was going on, that it is weaker out there. The consumer is feeling the pressures. The financing part of it is playing a big factor, because it's costing them more to take out some kind of loan or put it on their credit card if they're going to redo the kitchen or even the bathrooms, buy the appliances, these bigger ticket items. They're seeing the slowdown. It's another quarter of their comps declining. It wasn't terrible decline, but another quarter of the comps declining. But the stock kind of has rebounded. We're recording this on the day they reported, and it was in the green earlier before we came on the podcast. So I think people are basically saying, we already know that it's slow right now. The consumer's pulling back, but when the Fed is cutting, money's a little cheaper, they're going to come back. They're still going to do the kitchen. It just might be, middle of next year instead of right now. So we're going to buy the stock here because they've come down off their highs. What do you think about like this home building, even with the home builders? So like a Toll Brothers or, Pulte or any of the home builders, really, most of them are still cheap, even if those have rallied as well.
Yeah, pull up the HD and Toll consensus charts. Let's just do it real quickly if you got it available.
Yeah.
So you just did Builder.
So I just showed Builders First Source, and I want to look at Home Depot, even though they did report some weakness. So you can see it's still projecting the growth, but it is coming down off of what the analysts all thought it would be. But the shares, I feel, on Home Depot haven't really pulled back quite enough for me. It's still trading at 22 times. It's a little pricey. But this is also interesting to me that it's trading in this narrow range the last couple of years, and the street hasn't totally given up on it. It doesn't want to, and for right reasons, because Home Depot is a powerhouse. When we are doing something to our homes, we are going there, and Lowe's. But, it's not, the doom and gloom isn't really being priced in here, I don't think at all.
No, now go to one that I like that's in my large cap trader, EQIX.
DQ.
EQIX.
Oh, EQ. EQIS?
IX.
IX.
EQIX.
Equinix.
Click on that.
Wow.
$830 stock. Now click on its chart. Now, I bought this not long ago, and it's been going up during this latest panic. So I'll show you why. Look
Yeah.
this
Why is it? How does it have this earnings growth? What does it do?
Okay, so Equix is a REIT
Okay.
that builds data centers.
Oh, that's right. I knew I heard them somewhere.
Now look at that price
I'm
and
going to look at the
consensus chart.
detailed earnings.
Yeah, you're
Sorry, I
looking
have
at
to look.
at that chart. That chart is a thing of beauty. I mean, look at the
It
chart.
is.
It's just for showing you the growth you want to see. Like,
And the earnings
go back
growth.
to that chart if you got it. It was so smooth and nice and upward.
Price and consensus. This is what, for those of you who are listening, this is what you want to see. It's straight over to the right. The analysts are, pretty confident every year of the earnings growth. It's very consistent, and that is what you want. You're not getting any surprises in there. You're just getting very nice earnings growth year over year.
Right. Now we have a similar pattern in the chart at Home Depot. It sparked up, at the exit of the pandemic in late 22, and then it range traded, but it popped over it recently. And now it's underneath that fair value at 920. You could buy it at 800, which is why I did, and it's rising up towards that level. So it's very similar to Home Depot in the sense it's in that range for 2 years, but the underlying fundamentals here are just phenomenal.
Yeah,
right?
Anything with the data centers, right? I wanted to look. Okay, so it does pay the dividend. I was interested in it being a REIT, and it's a little over 2%.
A low beta, 0.7 beta, PEG ratio 2.3. I look at this and say, look, in this environment where rates are going to be cut or falling like they did, this thing can be running because it's got funding. It's buying debt for all this stuff, buying these data centers. This is a model where real estate gets a bid, and the real estate I want to own is stuff that works, which is these data centers.
Yeah, that's a good angle to play the data center mania on. I wasn't thinking about that because, yes, the cheaper money is really going to help these REITs, and they're in the hottest area.
Yeah, that's it. I mean, I thought a thing we got to point out to people on shows like this is the big name in the big industry is all you need to do.
Does this go into your, you don't have to be a genius?
Right.
You always tell me that.
As you know, you golf with me on if you want to talk recession, you get one hole on the first tee to give me those payroll numbers or we're done with that. Because I will not spend 18 holes talking to recessions with you. The same thing goes with stocks. Give me the big industry and give me the big name, and that's it.
Well, that would be true of, that's true of Home Depot, Builders First Source as well. Yeah. Those are like no-brainer ones.
Yeah, don't get fancy. It doesn't work. It doesn't work. What works is, and this goes back all the way to speculations of a stock market operator way back in the 20s. The major industries that are in play and the major companies and stocks you want to own.
Yeah.
So I just showed you Equix, right? That's a great stock because it's in a big place and it's happening.
Yeah. What do you think about the banks? Because I'm thinking if the mortgage rates come down quite a bit, people will not only buy more homes, so there'll be more mortgages issued, but they're going to refi. And quite a number of people over the last, 2.5 years now have mortgages over 6% and a lot over 7%. So there could be a big push for refi, and that is very lucrative for the banks if they have that business going. Should I be looking around in there, or is that still not really where I want to be?
Well, again, that gets back to statistics versus summary statistics. We don't know all the net effect of all the banking businesses and how big and small they are. So we just don't know that.
I feel like it's hard to do the individual banks anyways. Like I used to know, Wells Fargo, they had a big mortgage business, but then they got rid of it. So I'm not even sure who is the big mortgage guys.
Right, that part. And then also I've been noticing, inventories in houses in the South are exploding higher. Some of that's climate change. Some of that's insurance rates, which is climate change. Some of that is, moving back in different patterns for jobs after the pandemic, finally doing it. So the problem here is you don't really know how to net all this stuff out.
Yeah.
it's very hard to net things out because you can hear one story and not know how big of an event or long an event or how much counter current events are going on, right? So we know there's more inventory in the South. Well, we also know there's more jobs in the South, and then it's basically a hot area of the economy. So maybe the inventory is higher, but it gets absorbed quicker, right?
Yeah.
So, I mean, I can get bearish on the South by throwing one number at you. I just did. But I could talk myself out of it just as easily.
Right. Yeah, that might be a little more complicated area to get into than some of these other ones we've been talking about. What about something like I put up a chart of Winnebago, ticker is WGO. They make the RVs. The RVs have been crushed down as those rates went higher. You're not going to finance into an RV right now. You're just not. So the sales have come way down. But I haven't really looked at this chart in a while, and I am surprised that the stock is mostly moving sideways here too for the last couple of years, despite look at those earnings going the opposite way of Equinix, down and to the right because sales are way down, their margins aren't as good, and they have been cutting their earnings the last couple of quarters. But do I wait for a breakdown in something like this, or I just disregard RVs altogether? But this should have a rebound too when those rates come down.
Well, you brought an interesting point up because this market's not discriminating, right? The market's going sideways on names for years.
Yeah.
It's a very narrow market with big leaders like NVIDIA taking us up and holding us up. But now Home Depot is sideways 2 years. The Equinix was basically sideways for 2 years. This thing is sideways for close to 4. The market's not discriminating. The market should be pricing up Equinix and pricing down Winnebago, and it's not. So then your question is, during a rate situation or perhaps some slowdown in the economy because of the rate hiking that has already been done, that comes with a lag effect, you just don't want to be in Winnebago because it could break down. Right?
It could, for sure. Yeah.
So I just wouldn't want to be here because it could break down on me. Right?
Yeah.
GM Smucker's really interesting. There's a nice one.
Yeah. What about something like Smucker's? I just brought up this chart too. I haven't looked at this in a long time, but I heard people have been talking about it on social media because I guess if we go into recession, we're all going to eat peanut butter and jelly. That's what they've been talking about, which actually might be the case. I might be more likely to buy more of that. But this earnings is very nice. It's straight and consistent, but it's showing growth. And the stock has come way down.
The stock price. Yeah, this is a great chart. This is a great value, right?
Yeah.
So
maybe something like this.
Super sharp because you get the valuation. Everybody sold off the at-home food at-home names like Jam Smucker for the rise to the service economy in the last year and a half. And then earnings still kept going exactly what you want, and now they're in a good place for a buy. You got to like that stock.
Yeah, it's trading at 11.7 times forward earnings. It hasn't reported yet, though. So it's reporting at the end of August. If you're listening to this podcast in September, it's already reported. But you can see it's on the fiscal year. So this year, only 1.2% earnings growth, but next year, 8.5 is expected. So we'll see if we're getting that. But they have a pretty diverse portfolio of, big brands and we're always going to eat and drink our coffee and all of that. And you might be turning more to, some of Smucker's items instead of eating out.
Yeah. And that gets back to the other point is it's not a recession that's driving consumer confidence down. It's not what considers people that 59%. It's the high prices that people are seeing out there for things. And they're basically staying, again, it's a net effect. The fact is to go buy stuff at J.M. Smucker out of a grocery store and save money and eat at home. So this is what can happen that has nothing to do with a recession. It has to do with high relative prices that people are experiencing.
Right. So that things are very tight for them as if maybe we were in a recession and things were really slow. But it is we've all felt it. just even going to, McDonald's has talked about it. They're seeing it in their customers pulling back even at the lower end because it's just very pricey to go with your family out to eat or go anywhere really these days. So
yeah, again, that gets to another really critical point is, there is economic strife out there. Doesn't mean the economy is breaking down. It means people are making relative decisions in affordability and being cautious and being rational in the face of higher prices that they don't want to pay.
Yeah.
So travel is going down because I say, hey, it's $600 a night hotel room in Santa Barbara. Do I really need to go up to Santa Barbara for the weekend?
No. I've looked at those hotels, John, and I'm like, no, I can't do it. That's why I haven't come out there.
Yeah,
I can't. Yeah.
I would tell you to. I would be like,
and some of them are for like it's not even, we're not even talking about like the Ritz or the Four Seasons or whatever else is out there. These are like, I'm looking at the low guys,
I know.
Yeah.
I'm telling you not to come. I would not come myself. I mean, I had friends out here and they stayed in my spare bedroom, and they had other friends out here that came along with them, and they were like, can we stay at your house? And I'm like, I just don't have room.
Right.
Because, it's bonkers. And you say, why am I doing it? Well, it's not a recession. It's this price gouging of these opportunistic hotel chains, and they're going to play the game until they don't have to. And why step up? I wouldn't step up. I wouldn't do it. I'd be staying home making peanut butter and jelly sandwiches and riding it out.
Right. Well, and we are seeing some of that, right? From the travel companies, they've said they are seeing. Booking said in the U.S. they're seeing a mild trade down. So instead of spending the $600, maybe they're staying at the Motel 8 that's there for. Those are still like $250 or whatever craziness, but they are stepping down a little bit in the quality now because the prices have just gotten so high. But they're not really pulling back. They're just stepping down.
They're stepping down. I mean, again, this is the going away from extraordinary, exciting language which social media gets you attracted to versus, less attractive language, but more accurate language about situations that you are seeing and experiencing.
Yeah. Okay. On that note, I'm going to recap the stocks we talked about. There was Builders First Source, which I own in the Value Investor, ticker BLDR. Home Depot that just reported, seeing kind of the same things as Builders First Source, ticker HD. Then John talked about Equinix. I'm probably saying that wrong, but everybody on the podcast knows I can never pronounce anything. And it's E as in Edward, Q, I, X as in X-ray. And he has that in his large cap portfolio. And then we briefly covered Winnebago, ticker W as in Wayne, G as in George, O, WGO. Smuckers with the interesting, very nice chart. Ticker S as in Sam, J, M as in Mary. And I briefly mentioned just booking there at the end, ticker BKNG, but I don't think travel is really where, people want to be right now either, John, right? I don't think the travel stocks, especially if we do think there is going to be further slowing or like a mild recession, travel is one of the first things that does get pulled back, like not just trading down, but they pull it back all the way, and then we do the staycations again, and then we shop at Home Depot during our staycation. That's usually how it works. We buy that outdoor furniture somewhere at the Home Depot. So definitely be sure to tune in because I'm going to have John again later on this year, and we'll see where we stand then. Maybe we'll be in a recession, maybe we won't be, but we're going to have the end of the year show always, which is very interesting. So you don't want to miss a single episode of the Market Edge. Get us somewhere on YouTube. You can check out the YouTube version, the video version on Zacks.com/YouTube, or put in Zacks Investment Research. You'll find our YouTube channel. And I know many of you are over there already checking us out, or you can just listen in on Apple. We're on Spotify. We're on Amazon Music. Just about anywhere you can get the podcast, you can get us. SoundCloud too. We've been on SoundCloud the longest, but get us somewhere. And I'll see you again next week with some more stocks.